B will take us through their presentation. Team B, all the best.
This is Team B presenting an equity analysis on KCB. My name is Rotich, and I'm joined by James Njogu, Joseph Theuri, Keith Maru, and Bob Mani. We issue a buy recommendation at target price of 33.71 shillings, which is an upside of 38% as of 17 February 2017. KCB is the largest bank in East and Central Africa. The graph depicts how the group stock has been performing over the past 52 weeks. So, ladies and gentlemen, before we tell you why it's a buy, let's know a little bit about the business. KCB has 4 main segments, and the largest contributor is corporate banking at 34%. When it comes to group stock and shareholding, KCB is a holding company with subsidiaries within the East African region. And when it comes to shareholding, the government of Kenya is the largest shareholder at 23%. So why are we saying it's a buy? We came up with 3 key drivers that made us decide that it's a buy. One is digital channel growth, whose revenue contribution stood at 65.6% as per the 2016 financial report. Secondly, we have profitability amid strong regulation. Here we consider interest rate capping and IFRS 9 expected to be implemented on 1st January 2018. Finally, we have local experience. The bank has been in the region for a very long time, and as such, it knows where to take its business and the right kind of partnerships to form. An example is the partnership between KCB and Safaricom, leading to a product called KCB M-Pesa. So, ladies and gentlemen, what are the strategies? KCB has a strategic framework expected to be implemented between 2015 and 2019. It has 7 key areas. However, we focused on 3. These are robust IT, consolidation of international businesses, and finally, strategic partnerships. Thank you. I hereby welcome Keith.
So to begin with our industry overview, we'll begin by having a look at the macroeconomic environment in Kenya, having been able to understand how the business is operating. So as we can see, the stable macroeconomic environment has led to a GDP growth of 5% over the last 4 years, and this has been attributable to economic growth within private sector consumption, as well as robust demand. Moving on to the state of the banking sector, we see that the proportion of total assets is at 56%, which is 3.5 trillion, quite impressive for the banking sector. The banking sector is currently moving to the mature stage, with technology driving up profits and operational efficiencies being increased to be able to lead to banks reducing their costs. Now, trends in the banking industry will begin with the interest rate capping, which has been the most significant. It has led to a decline in credit growth from 17% down to 5% between Q3 and Q4 of 2016. Moving on, we see that customer deposits currently stand at 2.49 trillion, and the growth of average pre-tax profit has been at 13% and has been increasing consistently from 2011 to 2014. Now, in terms of profitability, it might have taken a slight dip to 134 billion from 141 billion, but this is attributable to operating expenses rising faster than the profits. Moving on to the Potter's 5 forces, we begin by affirming that the most significant factor is competitive rivalry. The undifferentiated products and the threat of substitutes playing a major factor within the Potter's 5 forces. Now moving on to the positioning in front of its peers, we see that in terms of net assets and profit before tax, KCB are the lions among men, and they lead as a result of a couple of strategies which my ally alluded to earlier. Now moving on to the market share analysis, as you can see, KCB is only lacking in terms of market capitalization, and it plans on increasing this shareholding to 16% by capitalizing more on fintech, which is likely to drive it up to 40%, as well as consolidating on a regional basis. Now moving on to the leadership of the firm, which has been instrumental in its positioning, we assign a score of 6.8 owing to the OECD criteria of governance, as displayed there, and we assign this score based on subjective estimates. Now, moving on, we saw that through the KCB Foundation and its Njogu program and the Mifugo Nimani program, its outreach in terms of corporate social responsibility remains quite strong. And I invite JT, the man with the figures, to be able to take us through the financial analysis. Thank you.
Examining KCB's financials, the numbers speak for themselves. In 2016, KCB recorded a profit before tax of 29 billion, which represented a 10% increase from the previous year. This was backed by total interest income of 62.8 billion, with gross customer loans of nearly 400 billion, and a net interest margin of 9.6%. In the same year, KCB recorded an ROE of 22.2%, with a 5-year compounded annual growth rate on PBT at 24%. Now, as much as these numbers depict of KCB's outstanding performance, we cannot ignore the effect that the interest rate capping will have moving forward. On this front, with reduced margins and more stringent regulatory requirements, we expect that banks will now focus on non-interest income, employ cost reduction strategies, as well as enhance their asset quality. So what steps has KCB taken towards this? We see that the non-funded income has been growing year on year, with NFI to total income arriving at levels of 32.3% in 2016, and we forecast that by 2020, this would have risen to levels of 37.3%. On a cost perspective, we see that the cost-to-income ratio has been steadily declining to levels of 47.6% in 2016, and we expect this trend to continue moving forward. The loan growth as well as the deposit growth has been above industry numbers. However, examining the asset quality, we see that KCB recorded an NPL to loan ratio, kindly move to the next, thank you, an NPL to loan ratio of 8%. We compare this to its peers, and with the exception of Standard Chartered Bank, we saw that KCB has an NPL to loan ratio higher than its peers. However, if the macroeconomic outlook is positive, we expect that this number will come down. And I invite Bob to take us through the valuation.
Thank you, Joseph. So with regards to the valuation of KCB, we considered four standard approaches. First off is the dividend discount model. And in arriving at the cost of equity of 20.67%, our key assumptions were as follows. Risk-free rate of 13.11%, representing a yield on a 5-year treasury bond, a beta of 1.3, and a market risk premium of 6.4%. Other key assumptions were a payout ratio of 37%, representing the average of the past 3 years. And in arriving at our terminal value, we considered using the H model as opposed to the golden growth model, as we saw it more prudent to assume a linear rate of growth of the dividends up to the terminal growth rate of 5%, which we pegged to the country's long-term forecasted GDP growth rate. All this factored in gave us a price of 32.98 shillings. Moving on, we also considered relative valuation, residual income valuation, and the key assumption here was that ROE will range between 21% and 23% going forward. This is above the cost of equity of 20.67%, implying therefore that KCB will give returns in excess of shareholders' expectations going forward. We also consider relative valuation, considering price to equity and price to book value multiples. And in selecting our peer companies, we consider banks currently listed in the Nairobi Security Exchange, the exemption of National Bank of Kenya, which recorded significant losses in 2015. This gave us a price of 36 and 30 shillings respectively. So how did we arrive at the final price of 33.71? Well, we placed higher weighting to BDM and residual income valuation, as this look at the intrinsic elements of the company, factoring growth prospects going forward. While relative valuation look at tend to have a more static approach. We also did a sensitivity analysis of this final price, considering CBR, cost of equity, and terminal growth rates. These were the most sensitive elements in our model. And as you can see, the price ranges between 31 shillings and 39 shillings, which still makes us reiterate our buy recommendation. I know James to take us through risk analysis.
Thank you, Bob. In our risk analysis, we developed a risk matrix showing the potential risk impact versus the likelihood. We found that both forward risks, cyber risk, and economic risks and political risks are the main risks moving forward. With the upcoming general elections, we expect credit uptake in the economy to slow down, and this will affect KCB's margins. And KCB's strategic move towards digital channels, we expect KCB to continue facing cyber attacks and cyber crimes in the future. However, KCB has taken prudent measures to mitigate against these issues. To mitigate against economic risks, KCB has diversified its loan portfolio across the different economic segments. To this front also, KCB has raised an additional $75 million, which presents Tier 2 capital, and we believe this will act as a buffer against any unexpected economic shocks in the future. Also, to mitigate against fraud risk, KCB has partnered with Net Guidance. This strategic partnership will help KCB mitigate against any operational risks in the future. Also, KCB has updated its core IT systems, and we believe this will mitigate against cyber attacks and cyber crime in the future. However, we wanted to look at the intrinsic effects of these risks on the valuation. We simulated on the key drivers, the CBR, the loan-to-deposit ratio, and the terminal growth rate, which was pegged at the GDP. We used a multi-color simulation, and through our 10,000 iterations, we arrived at a mean price of 33.59. Ladies and gentlemen, note that this is close to our target price of 33.71. This closeness puts KCB well into the buy zone. In our statistics also, we concluded that KCB offers a near 90% upside potential. This further reinforces our buy recommendation.
To wrap it all up, ladies and gentlemen, considering the key growth drivers we put across to you, as well as the risk mitigating factors and the results of our Monte Carlo simulation, we reiterate our buy recommendation. Thank you. We welcome your questions.
You attributed the fall in credit to the rate cap. Yeah, the red cap had only been, by the end of the year, had only been there for about 3 to 2.5 months.
What section particularly?
I think in one of the opening statements.
Mm-hmm.
The other thing that I just wanted to find out, in terms of your valuation, you use 5 years. 5 years to basically, as your 5-year bond yield. I just wanted to get your reasoning behind that. Yeah. And just reiterate why you use the H model.
A treasury bond is ideally given by the government, and in this sense, it's a risk-free security. Why we choose 5 years? We believe that over those 5 years, the shocks that will be in the economy will be reflected by this security, hence to be all factored into that final price. That's why we chose a 5-year treasury bond, as we deemed it to be a risk-free rate. Then with regards to the H model, this was basically used in arriving at a terminal value, and as opposed to using a 2-stage or a 3-stage model, we assume the H model because it assumes a more linear decline in the rate of growth of the dividends over the focus period up to the terminal growth rate of 5%, which will be for perpetuity. So we saw it as a more prudent means to forecast our dividend growth.
On the first question you asked, we agree that interest rate capping is an issue, and if you look at the bank statements, it heavily affected Q4. That one we agree. But these are the drivers that we saw that will drive the company for the next 5 years. We were agreeing to the drivers of the company. We're not saying that it actually affected to a great extent the financial position, but these are some of the drivers that are expected to come. But what we're saying is, in as much as yes, we have this regulation that are coming in, the company will still be profitable.
The company will still be profitable. Have you considered what impact you'll see in terms of ROE? You talk about an ROE of 22%. What will the impact of interest rate caps? That's question number one. And then you mentioned about NPL. So you said Stanchart is the only bank that has high NPLs. But when you have high NPLs, what does that essentially force a bank to do?
So non-performing loans, just say the loans, when you issue the loan, the interest that is coming back is non-performing. So when you have, we looked at the score based on these peers, so taking tier 1 banks. So we also did this for 2016. What you see here is 2014, 2015. So what we see is Standard Chartered Bank in 2016, for example, had an NPL to loan ratio of 12%. KCB had one of 8%. So essentially what we're saying, if a bank cannot control its levels of NPL relative to its loan ratio, it's not a good investment, because now they're giving out money and they're losing it. So the higher the ratio, the worse it is. However, when you look at KCB's levels, they're not alarming levels where you would say this company is likely to go down. However, as we noted, they are high compared to its peers, and they should make effort to bring it down.
Make effort, and also in case they're not able, I guess the impact would be to increase the provisions. If you increase your if you have a lot of bad loans, you increase how much you provide for it.
Yes, that's true.
So maybe an analysis in terms of how much they're providing would be a bit more useful. And then what I guess I didn't see a lot of, let me talk about what are 5 forces. So if you're in an industry where your products are undifferentiated, where do you generate your competitive advantage? It comes from costs. For a bank, that would be cost of funds. That's something else. Where do you see that in terms of cost of funds? And then also, I guess the last point, my last question is around ROEs and comparing against other banks. It has an ROE of 22%. Did you look at for other banks? And you know, if you're talking about what their competitive advantage is, fintech, how are other banks playing in that space, and what opportunity does KCB have that other banks don't have?
So to begin with the Potters 5, if I've understood your question, you're asking for KCB's source of competitive advantage. So to begin with, as I mentioned earlier, they want to invest more in financial technology. What this is going to do, it's expected to increase its operational efficiencies and it's going to eliminate redundancies, probably within branch level transactions or branch operations. So in terms of cost to income ratio, consistent with what my ally spoke about on the financial analysis, we expect it to continue declining.
How does that compare to the other banks? Equity, for example, with Equita?
Okay, let's start first with profitability. You asked about ROE for the companies. So this chart shows a rank of the other peer companies based on, first, we did the PBT and also our return on assets as well as return on equity. So what we saw was, on PBT terms, from 2011 to 2015, KCB was always ranked number 1 on that front. On ROA, the latest being 2015, it was ranked 3rd. And then ROE, we saw equity coming first, and then we saw KCB coming 4th. So we combined all of them, and then we averaged the numbers, and then we came up now with a combined front. So this is how we compare the peers. And then the other question you alluded to was, again, to do with ROE. Kindly remind me.
I guess the questions around ROEs compared to its competitors. If you looking at your chart, I'm seeing look at equity for 2014 and 2015 seems to be better. INM is second best. And KCB is 5th and 4th for 2014 and 15.
Yes.
So I just want clarity around that.
So my question would be around why you chose to weight DDM and residual income method to be more than the other ones, especially price to book value.
So with regards to the final weighting, we placed 40% and 40% to DDM and residual income. These are absolute valuation techniques which look at the intrinsic value of the company, and so they factor in the growth prospects that we factored in, all taking into account all the different digital platforms that we expect to reduce the cost and everything. So all that was factored in those two methodologies, as opposed to, as much as price to book value and price to equity are very important in terms of getting to know how a company is valued compared to its peers, we believe that they tend to give a more static approach because they look at one point in time. So we believe that looking at intrinsic methods is a more prudent measure. So we placed higher weighting on that.
I get what you're saying, but I think you need to look at whether that's the best method of doing it. The other question would be around, and you've said it's a buy recommendation. So the question would be, did you look at the management skill and their ability to keep on growing this particular business to whatever intrinsic value you're looking at? Because that's one of the areas where a shareholder is fully dependent on the management to execute the growth strategies that you just talked about.
To begin with, we came and had a look at the foundations for effective corporate governance, and I believe that's the question you're alluding to, so before my colleague gets to it. And the score that we assigned to them, which is relatively high, was based on the committees that they form around the technical skill of their managers. So the subcommittees, which are 7 within KCB, are all equipped to handle some of the issues which arise in terms of governance, and I believe my colleague can finish it off.
More to that is we looked at this company using the CAMELS rating. We assessed it based on capital, asset quality, management quality, earnings quality, liquidity, and sensitivity. So as you can see, management quality, we gave it a high rating of 1.58. If you go to the key, that translates to a satisfactory, meaning that it is fundamentally strong, stable, and can withstand business fluctuations. Supervisory concern is very little. So in that, we were looking at earnings. We evaluated them based on earnings, how well they can grow their asset book, as well as the quality of, but the quality was kind of also pushed towards now asset quality of the book. So how well they can grow their loan book, how well their efforts towards attracting deposits to the company. So we looked at all those elements, and that is the rating we give them.
Finally, on that, KCB is usually considered a leader in the Kenyan market in terms of when it comes to the banking sector. And that can only happen if the leadership at the top is good. They've been the leader when it comes to digital, and in as much as, yes, they still haven't joined PesaLink, the management, the PesaLink is a new product that is coming in. So in as much as they were the first companies to join in that bandwagon, going into that direction. They have seen reason enough that this is a good thing and it will benefit us as banks. So what have they decided? They decided, okay, as much as we already have a partnership with Safaricom, let's go on board with these fellow banks of ours and let's make money.
I have 4 questions. I'm going to ask them a bit more from the angle of an investor. So, as an investor, you're trying to convince me to buy KCB. The banks are in a bit of a conundrum. You have the central bank introducing ability to buy bonds through the phone, which targets more the retail market. So, if KCB was to focus more on deposit growth, and that's my first question, your challenge here being that you have a cap on the interest you can pay on savings, which means a lot of the retailers are going to prefer to open a savings account to a current account. How then are you going to drive your deposit growth? Right, that's first. 2, you've spoken about the fintech. Now, fintech in relation to the NPLs, how are you going to handle your NPLs if you're going to disburse a lot of your loans through mobile phones? I think KCB has closed one of their fintech lending modules after the NPLs became too high. So how is that going to be sustainable relative to the NPLs? My other 2 questions are a bit more on the valuation. The payout ratio of 37%, did that take into account the payout for this year? That's the 2016 payout. And how does that skew your results in the context of how do you expect that payout to be going forward? Okay. My last question was in terms of your beta. I think you showed a beta of 1.3. That essentially says that KCB has a higher volatility than the market. So in terms of a bit more clarity on that, is this your beta is over what period of time? Is this a 5-year beta? Is it a 1-year beta? And what's the frequency? Is it a daily, weekly, monthly beta?
So maybe I can just start quickly on the beta of how we arrived at 1.3. So ideally we got it from 2 sources. Number 1, we looked at what Bloomberg Terminal gave us, which was 1.4. And we also did our own team estimates, which we regressed the shares return compared to the market's return over a period of 1 year. So that gave us 1.2. So we took a prudent measure and took an average of the 2 values to give us the 1.3. In regards to the payout ratio, that 37% did not factor in 2016. It's just from 2013 to 2015, that average. Yeah.
The other question was on the fintech.
With the group's strategic move towards digital channels, we realized that there is more potential risk towards that. Yeah? So what KCB does, is credit scoring these days. You can credit score an individual. So once you can do that, you can assign a certain risk to them. And once you can able to credit score somebody, you'll be able to control risk coming from that person.
Yeah. My last question was on the deposit growth.
Probably just to start with, is KCB has a very strong brand. So the manner in which it has positioned itself, it gives depositors the confidence to put their money, saying, I will find it when I come back. So one of its strengths is actually that. So you have a brand name that is trusted. I think also probably when you're looking now at other strengths of the bank, you look at the strength of management, like I alluded to. So management is taking prudent measures. They have a very good marketing strategy. Keith, on the social media strategy, they were ranked the first bank in Africa.
They were the first bank on the Africa Brand Index, and that's ahead of its competitors in countries such as South Africa, which has HSBC and Nedbank, which are quite big banks within those economies.
Yeah, so we see deliberate efforts by the management to actually bring those loans.
And also a prospective source for the banks is to have a look at the economic potential of countries such as Uganda. Currently in Uganda, there's no agency banking. Regulations are being and probably have already been put in place to be able to increase the agency banking on that front. So that means that they can channel their deposits to sectors of the population that are relatively unbanked.
Yeah, thank you, Team B. I'm sure you'll want to stay within the room.
Yes.
Okay, so please take your seats. Okay, let's all applaud for Team B.